Okay, you've probably seen the headlines, right? Gold is smashing records. But honestly, that's not the real story. The real story? It's a number that's being whispered around by some serious analysts. A number that sounds, well, kind of impossible. So, we're gonna dive in, because what they're talking about, it could signal a massive shift in our entire financial world. And there it is, $9,000 an ounce. I mean, let that sink in for a second. That's more than double its recent highs, which were already historic. Now look, this isn't some wild guess from the internet. We're talking about a tail risk scenario that's being seriously modeled by major financial institutions. And that just leads to one huge question. Why? So what are we looking at here? Is this just a crazy speculative bubble that's about to pop? Or is the simple fact that this number is even on the table a huge blaring warning sign about the health of the entire global financial system? That's the puzzle we're going to try and solve. To really get to the bottom of this, we've got to look at the very foundation of our economy, and that's our trust in money itself. And that foundation, well, it's starting to show some pretty serious cracks. Let's just start with Exhibit A, $38 trillion. That's the U.S. national debt. And it's not just big, it's climbing faster than ever. You know, a number that huge, it forces you to ask a really uncomfortable question. When a government owes that much money, what is the cash it prints actually worth? And that question, it leads us right here to this key concept, currency debasement. It's really just the fear that all this debt is going to lead to one thing, printing more and more money. And that, in turn, makes every single dollar in your wallet, in your bank account, worth just a little bit less tomorrow. That fear is a powerful engine, and it's pushing a lot of people toward gold. You know, what's so fascinating here is that this isn't a new script. Seriously, we have seen this movie before. In the 70s, you had the collapse of the gold standard. In the 2000s, it was a weak dollar and the global financial crisis. And the driver today, record debt, plus this powerful new factor, de-dollarization. The parallels are they're impossible to ignore. And if history's any kind of guide, these are the exact conditions for an explosive move in gold. Okay, so if this crisis of confidence is the fuel for the fire, then who's actually holding the match? Who are the big buyers driving this surge? Let's follow the money. All right, so this breaks it down pretty clearly. You've got your usual suspects, investment demand, jewelry, even a little slice for high-tech manufacturing. They're all important, for sure. But the real headline grabber, the piece of the pie that changes the whole game, is that huge slice for central banks. They are the big story here. Just let that number sink in for a minute. Over 1,000 tons. That's how much gold central banks have been snapping up, on a net basis, year after year, for 3 straight years. That isn't just a big number. It's literally double the average pace you've seen over the last decade. This isn't a trend anymore, folks. It's a profound, structural shift in how entire nations are choosing to store their wealth. And this isn't just random buying, it's really strategic. You've got China systematically reducing how much it relies on the US dollar. You have Poland buying gold as a hedge against conflict happening right on its border. And India is fundamentally shifting its entire reserve strategy. They each have their own reasons, but they all point in the exact same direction, a deliberate move away from the dollar. And hey, if you want to know their number one motivation, here it is, straight from the source. The World Gold Council literally asked central banks why they hold gold. The top answer? It's performance during times of crisis. It's plain and simple. They think a storm is coming, and gold is their shelter. And it's not just governments stockpiling this stuff. The big money is moving too. Institutional investors are pouring into gold ETFs at a record pace. I mean, just look at this. September 2025 saw the single largest monthly inflow in history, over $17 billion. That's not speculation, that's conviction from the giants of Wall Street. So you have governments and big finance all rushing in at the same time, which leads to a very simple, very physical problem. There's only so much of this stuff on Earth. So can supply possibly keep up with this kind of demand? And this is where the real tension in the market is. On the supply side, things are kind of stagnant. We might have actually hit peak gold, which just means it's getting harder and more expensive to pull it out of the ground. But on the demand side, you've got these record investment flows, plus a brand new buyer that doesn't really care about the price, the AI industry, which needs gold for its advanced chips. That right there is a classic squeeze. But the market does have a natural brake system, and it's a big one, the jewelry industry. It accounts for a massive chunk of global demand, but it is incredibly sensitive to price. When gold gets too expensive, people just buy fewer necklaces and bracelets. So this acts as a pretty powerful counterbalance, slowing down a price that's running away. Okay, so the bull case for gold, it looks pretty compelling, right? But a good investigation has to look at all the angles. So what could derail this whole train? What could stop the rally cold? It's time to explore the bear case. Right, so the recipe for a gold bear market basically has three main ingredients. First, global tensions ease up, which reduces the demand for a safe haven asset. Second, the US dollar gets stronger, which historically pushes gold down. And third, interest rates stay high, which makes a non-yielding asset like gold way less attractive to hold. That's the scenario that really works against gold. And here's a key piece of evidence for the bears. Right now, the broader market isn't really panicking. You can look at the VIX, which is the market's so-called fear gauge, and it's pretty low. That signals relative calm, not the kind of 5-alarm fire panic that you'd need to launch gold all the way up toward that $9,000 target. All right, we've looked at the crisis of confidence, we've followed the money, we've checked the physical supply, and we've weighed the risks. So it's time to put it all together. What does all this evidence tell us? Okay, so let's get one thing straight. That $9,000 number is not the standard Wall Street forecast. As you can see, the major banks are looking at a still massive $5,000 range as their base case. The $9,000 figure, that's the break glass in case of emergency scenario. It's what could happen if there's a systemic currency crisis, a complete loss of faith in the system. But, and this is a huge but, history shows us that major gold bull markets often play out in two acts. You can see it in the late 70s and then again after the 2008 crisis. There's an initial climb, and then it's followed by a second, much more explosive phase. So the provocative question this all raises is, are we just now entering Act 2? And that really brings us to the crucial takeaway here. Maybe the question isn't, will gold hit $9,000? Maybe the real story is that a number like that is even part of the mainstream conversation at all. The very fact that serious analysts are modeling this possibility is itself a symptom of a deep, fundamental erosion of trust in the financial systems we've all relied on for decades. So, at the end of the day, we're left with this final question. When you see the price of gold on a screen, are you just seeing the price of a shiny metal? Or are you actually watching a real-time index of our trust in the currencies, the debt, and the institutions that shape our world? Is the real story here not the rising price of gold, but the falling price of trust?